Good afternoon, everyone. My name is Tracy Miller, and welcome to the Johns Hopkins Carey Business School's What's Next in Real Estate Speaker Series. This series is facilitated by our own Dean Alex Triantis and focuses on the challenges, uncertainties, and innovations in the real estate industry. For the first 45 minutes of today's event will be a Q&A with our featured guest, Julia Stevenson. At any time during the session, you are welcome to put questions for the speaker in the chat box. And following the Q&A, there will be breakout rooms for networking. It is my distinct pleasure to introduce our speaker for today, Ms. Julia Stevenson. Ms. Stevenson is an alum of Johns Hopkins Carey Business School. She's an originator of the LISC Strategic Investments, known as LISC-SI, and short for Local Initiative Support Corporation, of which she is an impact investor. Her academic background is in urban studies and corporate finance, which has supported her ability to analyze over 400 million in commercial real estate related transactions. Julia began her career in commercial real estate development, and over a span of 15 years, she's transitioned to fund management. As an originator for LISC-SI, she sources and structures deals for real estate and business investments for the Black Economic Development Fund, a $250 million private equity impact fund. She also supports the deployment of impact social capital for the company's place-based funds in cities such as Detroit, Charlotte, Dallas, and San Francisco. And maybe most importantly of all, she's originally from Detroit, Michigan, and went to its #1 high school, leader of all, Renaissance High School. Join me in welcoming our guest, Ms. Julia Stevenson.
Thank you very much, Tracy.
You're welcome.
Well, thanks so much, Tracy, for the nice introduction. Welcome everyone to another edition of What's Next in Real Estate. As you know, we explore some of the challenges, trends, and innovations of the real estate industry. And I see a lot of return folks coming back for another session, and some new folks as well, which is great. And it's such a pleasure to be able to lead this discussion this evening with Julia. So I'm going to start off with a few questions, but we really do want to hear from the audience as well. So please submit using the chat function or Q&A, and we'll get to as many of the questions as we can. So I guess, Julia, first of all, welcome, and great to be with you. And I think the natural starting point is for you to tell us a little bit more about LISC strategic investments, and also about the support corporation itself, and how they are related and what they do. So I'll turn it over to you.
Yeah, thank you so much for having me. It's truly an honor to be here and have this opportunity to share more about LISC. The acronym is Local Initiative Support Corporation. It's a nonprofit entity founded over 40 years ago by the executives of the Ford Foundation. And initially, the intention was to support cities in their community development efforts. So historically, LISC has done a lot of traditional lending and grants to community development corporations in support of cities. However, over the 40-year period, it's expanded to include, we have 38 local offices, we have local offices in 38 cities. We also have a presence in rural through our entity LISC Rural. But LISC Strategic Investments is what I describe as the investment management platform for our parent company. It's a wholly owned subsidiary. And through strategic investments, we're able to do untraditional impact investments. So still focus on a community development type mission and impact to cities and rural areas, but we don't have to operate within the same parameters of a specific footprint. We're able to do creative approaches to investments, whether it be loan participation funds or funds like the one where I originate and deploy capital, the Black Economic Development Fund.
Great. And when was LISC-SI formed as a formal arm of LISC?
So LISC Strategic Investments is only a few years old, and some of our funds have been created over a number of years, but really have become active within the last couple of years. So it's a relatively new entity.
Right, and we'll talk a little bit about sort of the surge of interest as well. I think that's particularly interesting. So there are different types of properties that you all focus on, but let's start with the housing. And we know that in many markets, particularly in cities, that many working families can be priced out of housing. So how important is affordability as a factor in developing a community? How much of this is a part of what you are doing?
Yeah, so when you think about community development, a lot of focus is on creating stability in neighborhoods and stability in individual lives. And one of the components of having stable neighborhoods and providing stability to just human beings is making sure that individuals and families can comfortably house themselves. They can comfortably afford rent, or they can comfortably afford their mortgage. And so there's a lot of emphasis through the Local Initiative Support Corporation holistically on affordable housing. I typically distinguish it as capital A versus lowercase a. Capital A being LIHTC or low income housing tax credit deals, where there's an actual restriction on the household income relative to the rents. That's where you see a lot of opportunity to create low to moderate income housing in neighborhoods where the market rents may otherwise be unattainable for the average American. Lowercase a is typically related to workforce or missing middle housing. It's that 80 to 120% of area median income, where there's no real restriction, but the rents are targeted to capture that demographic. But I think overall, in terms of the investments that we do through strategic investments and how we support our parent company's mission on just driving affordability, we're all just focused on creating stable neighborhoods, making sure that communities are developed thoughtfully. And that means making sure that not only is the housing affordable, but the surrounding area is walkable, livable, and you have amenities to your neighborhood that makes it a real neighborhood. And you can have a real ownership stake or a real attachment to where you live beyond it just being someplace that you could afford to be.
Great. Well, I know that one of the key funds within LISC Strategic Investments is the Black Economic Development Fund. Can you tell us a little bit more about sort of some of the investments that are being made through that?
Yeah, and I'm happy to share a link in the chat later to the website that talks about the investors in that fund. But really, I think that the Black Economic Development Fund was birthed out of corporations trying to figure out their social responsibility to the nation, to Black Americans, to just improve lives in general. And so because of the response to the murder of George Floyd, there was this new attention faced on how we address race and how we address inequities, not only in real estate, but just in the path towards economic development, wealth creation. So the Black Economic Development Fund was targeted to support minority deposit institutions. It was originally thought that there was a lot of opportunity to improve Black-owned banks and Black-led banks. It's evolved to include sponsors that are investing in real estate or businesses. And so now we have a lot of opportunity to tackle the issue of Black economic development through a multitude of assets and investment types. So it's really an exciting opportunity for us to hone in on Black-led sponsors, but also target deep impact and exponential impact through our investments.
Great. I'd love to hear more about those investments, but before I go there, you mentioned the social justice movement and how that has increased flows of capital. And if you go to your website, you talk a lot about sort of patient flexible capital. So I'm curious if you could say a little bit more about sort of where the capital sources may be coming from, or the opportunities and how that's grown over the last couple of years.
Yes, I think that large institutions like ours, where LISC is the largest community development financial institution in the nation, so we have the luxury of leveraging our name and our reputation to really bring in some of the top companies of Silicon Valley, some of the top companies across the nation and corporations. However, even in smaller institutions like mid-sized funds, there's been a lot of interest in developing either a fund of funds or an impact fund that targets Black developers, Black sponsors, or sponsors specifically targeting Black and Brown communities. I think that this whole reawakening, as we call it, I'm a member of Commercial Real Estate Women. We've been describing it as the racial reawakening, and I think that's a pretty acceptable term that I've heard. It's created an opportunity for even minority investment managers to create funds and introduce new capital to the market to target Black-led sponsors. We're also seeing the way that deals are structured respond to the opportunities. So going back to the Black Economic Development Fund, when we embrace a sponsor and try to work with them to invest in their deal, we're looking holistically at them. So a traditional private equity fund may look at a sponsor's strength, their background. They may look at their project team, the strength of their project team's experience, and their balance sheet to guarantee, if it's a loan, to guarantee the loan. A lot of times that can be exclusive because in minority communities, even if you have the direct experience having worked for someone else, you don't have it on your own. And so there needs to be some give and take and some consideration in how to mitigate risk for investments. So when you talk about patient capital, or when you talk about flexibility, that's what's needed. And that's what these funds are trying to achieve. And that's what the change that I'm seeing in capital markets. I do still think that there's a ways to go in terms of improving the implicit or unconscious bias in capital markets when it comes to diversity and developers, investment managers, sponsors. But I think that we've really been able to make a lot of progress over the last couple of years.
Well, that's great to hear. And I think that for impact funds like this, that obviously when people can more clearly see the impact that it can have on a community, that hopefully that will turn into a greater sourcing of funds to support those kind of initiatives. So let's hope it keeps growing rapidly. So back to the Black Economic Development Fund, curious if you could just share with us some of the projects you've recently worked on, or anything that you have in the works, so that we can get a better sense for what those projects look like.
Yeah, I'm really proud of what we've been able to achieve through the Black Economic Development Fund. We're a small but mighty team. And so, we've been able to enter into our pipeline some very creative deals that are business, including a Black female veterinarian who's had the opportunity to buy not only her practice, but the real estate. I believe when I looked up the statistics, Black veterinarians make up less than 2% of the US market of veterinarians. So imagine how much smaller that number is for a Black female veterinarian, and for her to have the opportunity and for us to be able to support the effort to purchase her practice with an existing book of business in a major market like Dallas, Texas. There's just no greater feeling. And it just proves the thesis that you don't have to sacrifice the investment, the soundness of the investment, to achieve the impact. We're still able to achieve a meaningful return for our investors. We're not in any way going around our fiduciary duty to achieve the impact. Like, all of this can line up. Another deal that I'm really proud of is a travel center. So it's technically real estate related, but still somewhat of a business. Travel centers, for those who don't road trip, are when you see like a Flying J or a Pilot, and it's got the petrol stations or the diesel pumps, in addition to the convenience stores and restaurants on inside. So we have the opportunity to finance an older Black man's growth from a small gas station to a travel center. He's a generational businessman in the Tuskegee area and bought the land that he worked on with his dad when it was a gas station owned by someone else. So, it makes us really proud to be able to support his ability to grow his business. That business will then, because of his proximity to a historically Black college, provide like opportunities for jobs to those students. And it will also directly contribute to the tax base. And it's a catalytic investment for that area right off of a major highway in Tuskegee, Alabama. So those are just a couple, but some of my colleagues, there are 3 originators on our team. Some of my colleagues are doing things in Charlotte with LIHTC financing, in Florida with home ownership, with the expansion of some of the historically Black colleges between DC and Atlanta. We're just really able to bring to our investment committee deals that we feel good about, that we feel passionate about, but also just make good business sense. Independently of the ethnicity of our sponsors, the deals make great business sense.
So you've talked a little bit about affordable housing, and you mentioned sort of retail or business opportunities as well. So what is, it's very interesting as you describe this sort of as a very ecosystem perspective of what, not just on a standalone basis, what the project does, but more generally what it does for the community. What are, so other than the categories that I mentioned of affordable housing and retail, what are the other and other businesses, right? And you mentioned, I guess, the travel stations as well. Any other types of investments that you're making through these funds?
Yeah, so one of the deals that received a lot of marketing is a commitment that we made that's related to the Dormitory Authority State of New York. And I feel comfortable speaking to this one because it's already publicly marketed. We provided a commitment of capital that general contractors who historically have been subs are able to use to demonstrate liquidity so that they can get bonding needed to bid on primary contracts. So if you think about, let's take it down to a small scale. If you think about when you want to build a home, you hire a general contractor. Unless you have the skill set to do it yourself, you hire a general contractor who will sub out the work. They may have a sub for drywall. They may have a sub for some of the structural components. They may have a sub for some of the mechanical components. On a grander scale, that's typically how construction works for government entities that contract out physical assets, the development of physical assets. And so where historically Black and Brown and minority, including women sponsors, would be under a predominantly white general contractor, now they're having the opportunity to bid alongside and compete. And that just historically has been an obstacle preventing diversification among prime general contractors. Interesting.
So we should probably track the number of times that you use the word impact, which is such an important word, and clearly very much behind everything that you're doing. So community development and community impact investing are not the same, right? And they serve different functions within the community. So maybe you could tell us more of how these roles differ and what are some financing incentives available for helping to advance impact of people and communities, maybe versus sort of traditional ESG metrics.
So I see community development more like how I described our parent company LISC, where it's traditional lending, there's grants, there's a lot of private-public partnerships with either cities or states, and a lot of it is targeting affordable housing, at least in the world that I live in, which is heavily surrounded by traditional debt and equity. Community impact investing, I think, is more specifically looking at just impact investing as a neutral terminology that captures double bottom line returns. So you have your profit, your cash profit, your cash return to your investors. But with impact investing, you're not just looking at that, you're looking at an impact metric that aligns with whatever your mission or thesis. So I think that the opportunity for folks in impact investing is more so related to the pricing flexibility. So in fund management and investment management, there's a way that you look at real estate assets. They're opportunistic when you're taking on high risk. They're value add when you're taking potentially an existing asset and improving it so that you get more value out of it. And then there's core, which is maybe just the purchase of a stabilized building and ensuring that it continues to be stabilized. There are prices, expected returns on those investments based on the category. So with impact investing, where a value add deal traditionally might target, call it a 12 to 16% return on investment, with an impact metric, you may be willing to give more on that rate so that the burden is less on the sponsor. And I know I'm getting really nuanced. You can thank my master's in finance for that, but I think in terms of incentives, it's more so looking at how the fund is oriented. And when speaking with sponsors, that's how I always talk to them in emerging development programs. Make sure you know your audience, know what their mission is, know what their thesis is, and make sure that your project aligns with that focus.
Yeah, so you made me smile because I was going to mention your MS in finance and the approach. I mean, you talked before about these deals have to make great business sense, and you've obviously talked about the impact side of it. So what is your, I mean, you've spoken to this already a little bit, but what is your approach to analyzing and evaluating the potential investments that the BED fund is involved with? Maybe you can sort of take us through how you would take a deal at a very high level and evaluate it to see whether or not it would satisfy the criteria that you have for investment.
Typically, I start with the model, the financial model. I want to make sure the numbers make sense. That's just how I'm oriented. Some people start with the narrative to make sure holistically the project makes sense. So the way I look at a deal is I start with the model. I want to understand what's the strategy, what is the business plan. So if it's, we can stick with housing. If it's a multifamily development that's market rate in Atlanta, where is it located in Atlanta? Does this target rent make sense? Does the projected net operating income lead to a estimated appraised value that can give me comfort with a reasonable loan to value metric? So in short, I'm still looking at the same relatively conservative parameters as I did when I worked for Eagle Bank. I don't deviate from, what makes sense. But as far as looking at the impact, if I can get comfortable with a higher loan to value limit, so if I can increase the amount of debt that the sponsor can access through our funds, but still write to a very comfortable exit, meaning who they'll refinance out to or who they'll sell to, then that allows me to give that sponsor a greater opportunity to actually build that housing or to actually achieve that targeted impact. If it's, call it, adding solar panels, like one of my sponsors in Chicago, there needs to be flexibility in how they have to manage the capital stack to achieve that impact relative to their overall construction costs. So it's not giving on the underwriting standards that any institution should be using, but it's just creating, thinking creatively and allowing for flexibility in terms of how I look at the whole picture from the day that I close my loan to when they exit, and what does that mean to the community, and what is the quality of the product that they're delivering to the community.
So we are, thank you for that, taking us through that. And there's a couple of questions here sort of related to that. So I'm going to, and thank you, everybody. Please continue to put your questions in the chat. So I'll address these not quite in the same order that they're up here. But first question is just to, I don't know that you have given us in the discussion so far a sense of sort of the range of funds from LISC or from through the Black Economic Development Fund. What range of funds are we talking about here? Just to give folks a sense of the size of the projects.
Oh, I see. Yeah, so I can say openly, the Black Economic Development Fund is a $250 million fund. However, because of how the fund is structured and the impact that we're trying to achieve, we limit our investments between 1 to 10 million. There's some flexibility with that. But what that number does, we're not necessarily going after the $100 million projects that require $60 million in debt. We're trying to target those in-between opportunities, the gap, which is, do you need subordinate financing at a reasonable price? Subordinate debt can be quite expensive. Mezzanine, some people call it mezzanine debt, sometimes it's mezzanine equity. That can be even more expensive than subordinate debt. So we're able to really fill in a gap by thinking about how to use those dollars, whether it's in senior or subordinate position. LISC strategic investments overall, and forgive me for not going too in detail because I'm only typically deploying capital out of the Black Economic Development Fund. But overall, we have several funds. Some are participation funds where we support community development financial institutions that are smaller, or community development corporations that have lending arm. And those funds may be place-based or may also have a national footprint. There's also housing funds like the ones in Chicago, and I believe the website mentions Dallas, and Detroit, my hometown. Thanks, Tracy, for that. Those funds have more flexibility in terms of the loan amount. I think all of those are debt. Actually, Charlotte does debt and equity. There's more flexibility in terms of the dollar amount, but they're specific in terms of the asset type, specifically housing focus. So I'm really proud of what LISC Strategic Investments has been able to achieve just through the diversity of the types of funds. So I'm hoping that I've answered the question as far as the range.
Yeah, no, that's fabulous. And there's another question that hopefully I'll express appropriately, either for LISC strategic investments overall, but maybe you want to answer this for the Black Economic Development Fund. It says, what percentage of LISC work is paid for via project revenues versus grants from the LISC sponsors? So I guess does that make sense? So in terms of where you're funding each one, how much of this is sort of self-perpetuating through the revenue versus sort of relying on the grant money?
That's not something I would have the answer to. I think it's a great question. We don't deal with grants directly out of the Black Economic Development Fund. It's purely just deploying the capital that we raise through our investors. But I do know that there are ways that we think creatively about leveraging our relationships internally with LISC partners and those local offices that have grants to just help sponsors achieve support. But unfortunately, I can't answer that question in the way that it was asked.
Sure.
Asking something that's more on the parent side of the company.
Right, gotcha. Another question about, back to sort of the impact metrics. Has LISC incorporated any environmental sustainability metrics in its impact investment?
We are looking at that. We are looking at being more intentional about including environmental metrics. We always try to embrace those investment opportunities that naturally have a green or sustainable design component. I have a deal in Chicago with a very ambitious developer that's targeting what's called the South Loop. And his thesis for his investment platform is that every community, every home should have sustainable design as a feature. And so when I was talking about solar panels, we're thinking about the deal in order to make sure that we can support that thesis, but we're also being more reflective in terms of our platform to see how we can produce new funds and new opportunities that are more specifically targeting environmental components.
Great, thanks, Julia. And I'm going to hold for a second on the Baltimore questions. We'll come back to that in a second. But how does LISC identify opportunity zones where you would like to reduce inequality, and where would you focus investments?
So I'm going to answer that with opportunity zone being a lowercase opportunity zone, unless they meant it.
Well, they did have it lowercase, so that's
okay.
appropriate. Yeah.
So I think that there's a lot of attention focused on big cities. I think naturally people are focused on San Francisco, Silicon Valley, where there's a dearth of affordable housing. I think that LA has experienced a lot of gentrification in neighborhoods that were previously affordable. New York is always someplace that can benefit from affordable housing. But I think that opportunities exist. LISC Rural is pursuing opportunities to expand broadband in rural areas. I think that that's something that, I wouldn't have thought of before joining, but when you think about the inequities that arose through so many children having to participate in school virtually, there's a lot of assumptions about who has internet access. Sure, we all have phones. Sure, many people have access to a computer, especially now that schools include computers automatically, but that says nothing to their ability to access reliable internet or being able to take advantage of all of the different services that rely on broadband. I think there's also opportunity throughout major cities and less densely populated cities, just to target that missing middle. That's been a hot topic as far as urban development. Again, missing middle just being those homes that are available for folks in that middle income bracket. A lot of attention, we can look to our backyard in DC and Baltimore. A lot of attention was on luxury apartments before the pandemic, just completely pricing out existing residents or completely changing the demographic makeup of a neighborhood. And so having more housing focused on folks in between what can be capitally affordable, just almost certain rent restricted housing, and the luxury is that missing middle. So there's opportunity there. And then I think we have developers like Bowman Keaty, who does a lot of place-based strategies where there's this partnership, and DC has done a great job of issuing RFPs, a partnership of developing like a Main Street feel in addition to housing. So it's more inclusive development when it comes to building up neighborhoods. So I would say that's where a lot of the opportunities that I see. Obviously, I'm looking through an urban development lens, but even working with our partners in LISC Rural, just a holistic approach to investing in these areas presents a lot of opportunities. Oh, and there was one other aspect that I think of. That's the integration of smart technology into homes and communities. So IoT, the Internet of Things, being integrated into cities and homes to make buildings operate more efficiently, to make, in theory, streets and sidewalks more safer. And, like just including things like charging stations. I think there's a lot of opportunity there that's yet to be explored on how to make real estate, physical, real assets incorporated and include the incorporation of smart technology.
Great. And one of the comments that you made triggered another question, which is how do you manage the trade-off between the improvements in neighborhood quality caused by your investments and gentrification? Local communities often oppose revitalization for fear that it will cause displacement. Have you faced such resistance when executing your grant work?
So we don't directly get exposed to resistance, but it is something that we're intentional about asking our sponsors. So there was a deal that unfortunately we passed on because we couldn't see how it holistically addressed that very concern. What happens when you reinvest in a community, typically through values, which if you know how to extract the value of your ownership stake in an asset is great. If you don't know how to extract that value, then you end up being overburdened by the tax implications of that improvement. So we ask folks that are doing for sale projects, for example, in neighborhoods that are slowly gentrifying, how are you addressing the impact of your deal relative to others? Are you pursuing partnerships and having discussions with the city about, tax relief, burden, rebates, or, some sort of like opportunity to give relief or defer taxes for citizens to be able to not experience exponential increase the minute you deliver versus what they've experienced prior to the turnover. I think also just making sure that you're not pricing people out in the instance of housing. It's being thoughtful about mixed income rents or including some rent restricted units. In DC, it's inclusionary zoning. In Montgomery County, it's called moderately priced dwelling units. I don't know what it's called in Baltimore. But even when you think about, small businesses and what happens to them, H Street in DC is a perfect example. A lot of people have a love-hate relationship with the improvements to H Street because it's displaced some of the businesses that have been there and made H Street H Street. Same thing in Shaw. Some of the businesses that have been there and made Shaw what it is are being displaced because owners are able to increase their rents. So I think that we specifically at the strategic investments just make sure to dig into that aspect when we make investments.
And to your point about working with the mayor's office in the various cities, you talked a little bit about the tax aspects, but also there's the aspect of rezoning. And so one question here from Michael is about, how critical is rezoning in the kind of development investments that you are making, and the subtext, I might think certain neighborhoods in San Francisco Bay Area in particular and elsewhere might need rezoning and cooperation from the city and city processes.
So I'm fresh off of reading The Color of Law. And in The Color of Law, he addresses historically how zoning has almost been weaponized to advance certain agendas. But, from our perspective, we're not directly related to the efforts on rezoning, but a lot of our projects benefit from the effort. And so, what we're looking at is making sure that if we're involved in a project where there is rezoning, it makes sense. We don't want to remove homeownership opportunities to make way for, top of the market luxury units that have rooftop decks and infinity pools or whatever the top amenities are right now. So that's not maybe something that would be a best fit for us. If there is a homeownership opportunity and there's an opportunity to build multifamily, we want to just make sure that when we see the project, there's still space for the existing residents to maintain their ownership and benefit from whatever the investment that's occurring.
Great. Well, we only have about 5 minutes left. And in addition to talking about real estate, I wanted to talk about you because I know we have a lot of students in the audience and others, alumni, who will be intrigued at sort of about your career. There were some interesting questions about Baltimore, and I'm sorry I didn't get to those. I know that that's on a lot of people's mind. I don't know, Julia, that because you don't do a lot of work in Baltimore, that we should direct them to you, but certainly a dialogue we have to keep having. But I think any insights or and experiences that you've had, because I'm sure our students would benefit from it. How did you get into this sector, and what opportunities do you see for career opportunities moving forward in this sector?
So my journey was a very winding path, and so I'm spiritual and wholly attributed to the grace of God. I was competing as a post-collegiate track athlete, we'll call it a professional track athlete, and I happened to be introduced to a woman named Deza Sealy, who was a Black woman like me, went to Brown University like me, majored in urban studies like me, and she was in commercial real estate. And she gave me the opportunity to work for her as a project manager while I continued to train. And that's how I fell into commercial real estate. From that opportunity and exposure, I was able to build relationships. And for those folks who are already in real estate, I know Tracy can attest to this based on her experience, and whoever else is on the call. It is truly a relationship industry. It is all about how you, who do you know, and your reputation. And so I was able to get other opportunities, including working for Howard County Housing because of the introductions that Deza made for me while working for her. And then by working on the development side and getting deep into the weeds of pro forma models, I had to figure out, what is this pro forma that people keep talking about, and how do I read it? And through trying to teach myself finance, I really developed a love for finance. So instead of studying real estate, I actually went to specifically study finance to strengthen my technical skill. And from my observation, I found that a lot of the developers who've been able to grow strategically and been able to be very thoughtful about their deals is because they have that strong finance background. But that's essentially how I, pivoted from track to commercial real estate. And after graduating from Carey, that's when I made my leap into more of the real estate finance side of things versus development.
So what I heard from that was Carey empowered everything. I hope I understand.
Carey is the beginning of everything.
Just one final question. Do you see any particular opportunities for women or other underrepresented groups, in particular in what you're doing, not just real estate, but in terms of impact investing?
Yeah, so I always identify as a Black woman. I am uniquely positioned in that, I always have to have both lenses. And I think that whether it's being underrepresented as by your gender, your sexual orientation, or your ethnicity, I think that what you bring and where the opportunity is that diversity of thought. So in real estate, I think that I've been able to offer value on occasion by having a different lens. A lot of Black individuals are accustomed to exposure to a very diverse socioeconomic strata, even within our house, even within our families. We may go to Thanksgiving and be with a family member that has subsidized income and another family member that is upper middle class or wealthy. And so having that lens and bringing it to the table allows me to think about real estate, who lives there, who wants to be there, who should be there, a lot differently. But I think also just in terms of thinking about the use of technology, if you have somebody that is not as able-bodied or differently abled physically, they're going to think about the physical space differently. They're going to think about business opportunities, integration of smart technology differently. So the opportunity I really see is in leveraging that diverse lens and looking at it as a value add, as opposed to an obstacle or challenge to overcome.
Thanks so much, Julia. And as my colleague, Professor Zhu says in the chat, it's really empowering to see role models like you. And I can't thank you enough for spending time with us today and sharing your insights and inspiring us. And so let me pause there and say thank you, thank you, thank you.
Thank you. Thank you. It's absolutely my pleasure. I appreciate having the opportunity to speak with you all.
And I hope you stick around for our networking session. I just also wanted to mention that our next event is going to be on March the 24th. We've invited a panel of experts to discuss leadership opportunities for women in the real estate industry. So we will continue some of the discussion that we just had, and I hope you all will join us, and I appreciate all the chat questions as well. So I am now going to turn it back to our network experts. Is this you, Nicole, or is it Liz?
It is. Thank you, Dean Triantis. Thanks, Julia. I recognize many of you may still have questions for Julia, and she has volunteered to stick around to really jump into breakout rooms with you. Take 10 minutes, maybe make a connection you didn't have before you joined this event. We are going to move directly into breakout rooms for 10 minutes. We invite you to share a little bit about you, where you're working in the industry, if you're a student, an alumni, if you're part of Julia's network. So stick around, make a connection. I will bring everyone back to the main room in 10 minutes. We'll shuffle and then go back for some continued networking. So thanks for sticking with us. We're going to move into some breakout rooms.